We are going to party like it's 1999, man. Powell just like lit the world on fire yesterday.
It was wow.
He cut rates like 8 times. Just
Oh wait, you did? Yeah, it felt like it, didn't it? My goodness.
Oh my gosh.
It's amazing how much the market loves him when he's not when he's very dovish and he's very he was talking sexy to the market yesterday.
Oh my gosh. Good morning, everybody. Brendan Rendo with the Homes in Orlando team, joined as always by Joseph Dion. We are the Orlando Real Estate Buzz, come to you every Thursday morning to bring you all the latest news in the financial world that affects both local real estate and the national real estate. Please don't forget to like and subscribe and join us every Thursday morning. Powell was in a good mood yesterday, wasn't he?
Right? Like I really expected him to come out very hawkish when in the presser, and then he was kind of like, hey, like maybe we've seen what we did.
We did good.
We done good. Yeah, like he was feeling himself a little bit, and the market just was loving him.
Oh my gosh. Hopefully, I mean, we kind of talked about it, and we'll go into some numbers. I think it was a good reaction, but it was a little over exuberant, a little more than, I mean, people just like went crazy. I mean, look at the bond market. This was, I mean, we're sitting here going, boom. I mean, it fell off the cliff yesterday. Look at this drop. We have what? The 10-year has dropped almost 100 basis points from close to 5, and we actually broke 4, and we're under 4 right now. We're sitting at 3.96, and we're sitting there. So, I mean, it's rates have really took a beautiful dive down, and it's just, it's great to see for people, because you're gaining probably what, about $30,000 with a point drop in purchasing capability, somewhere in that ballpark.
Yeah.
And with the way the housing market has really turned into a doldrum as far as sales numbers, you're hoping that, hey, first of the year, this will push people back up over the edge. I mean, I know we're still sitting at a very high debt to income ratio for most people, but if you can buy the same house and save $300 or $400 a month on a payment, all of a sudden where you were thinking, I can't do it right now. I'm gonna have to wait for the rates to drop. They dropped.
It's been big movement. I mean, the movement we saw yesterday and today, and the fact that we held it, like I kind of expected a little bit of a pullback today, and we haven't seen it yet. We still see the bond market going down. We're seeing MBS going up. Like it's very interesting, and I expect a little bit of a pullback, but we haven't seen it just yet.
Yeah, I mean, when was the last time we were actually below 7? Was it September? Maybe early October?
Yeah, somewhere
in that ballpark.
We definitely made big pushes, and this is great. Like I love this. Like I mean, it helps. Like that psychological barrier. Like 6s are always easier than 7s, and definitely easier than 8s. But I feel like 6s are a number where typically most consumers feel comfortable with that number. Like, does everybody want 3s? Yes. But I think a lot of people understand, like, hey, like 5, 6s, this is good. Like this is okay. It's a decent time to buy.
Yep. So I think, when we looked at the numbers, really, once we hit that, we broke that 6.5 mark, that's when we really started to see sales truly decrease. Was that 6.5 was just that barrier that people just could not get past in their interest rates. And we're getting pretty close to there. FHA maybe even a little bit closer, aren't they? I mean, where are we sitting FHA right now?
Yeah, we've got to see. I mean, 6.23. I mean, that's pretty aggressive. There's going to be some points on that right now. But I mean, the key here is that we're getting closer and closer, and we're seeing things get better and better. And the big thing that we've talked about in the previous weeks is our only concern is that we don't want it to happen too fast.
Yeah.
November was fantastic for rates, but December is turning into a duplicate of November. And that's one of my fears. Like, I don't want to be like, I hopefully I'm wrong with this, but what I don't want to see is a spurring of the economy that is going to push the Feds to say, wait a minute, maybe we aren't out of the woods yet.
Yeah. A reignition of inflation.
Yep.
Our number came in at 3.1, but the core number, which is your food and everything else, that was still sitting at 4%, which that's not not really too close to that too. That's their goal. And it was interesting to see. Oh wait, which one is it? Oh, here it is, CPI. Our favorite one of all time.
Yay! Shelter.
Shelter's still sitting at 6.5%.
Yeah.
And remember, that's 30% of your number. But the numbers I see out there is that the rents are coming down. So it's a little contradictory again. And one thing that pulled down the overall inflation number is fuel. Fuel oil had a 24% drop. That's huge. And our gasoline, we had everyone seeing gas come down, break the $3 barrier, which we haven't seen in a long time. So you had a lot of numbers pulling the inflation down. Actually, kind of a deflationary situation there. But when the household, they count that for 30% of your number, and that's still holding at 6. That's what's keeping us up.
Yep.
Right now. That's what's holding everything up. Well, this is something I thought was interesting this morning too. Is we love to watch our probability ratings for the Fed on where everyone thinks they're going to go, and I mean, they came out and they said 3 rate decreases next year.
Yeah,
right?
3. Just 3, right? 3.
Just 3. Yeah. Well, people think that we've jumped from nothing, 0 to 18%, thinking they're going to cut as early as January. I don't see it.
I feel like this is what we always say, right? Like, people respond to what? The news.
Yep.
Not what actually is occurring, right? It was like, and that's something that, what I mean that for us is maybe the Feds do cut in January or February or March, but the movement we might be seeing now may already put the rates lower than where they're going to go. And maybe the Feds cut 0.25% in March, but we're priced as if they were going to cut 0.5%, and we actually see rates get a little bit worse.
Yeah. And I think that's where we're headed, is we've overpriced it so much, the rate cuts, that people are going to be disappointed. They're going to be calling up saying, hey, the Fed just cut rates. Well, rates are actually a little bit higher today. That doesn't make sense. Well, yeah, it does, because they built it in. We say that all the time. Well, the Fed raised the rates, but it was already built into the numbers. It was already built into the numbers.
We move numbers on speculation.
Exactly. And it seems like the speculation waves are so much bigger than they used to be. I mean, a lot bigger than they used to be.
Yeah.
So you got in January, you got 18%. But look at this. When we go to where people think they'll be at the end of next year, we're at 5.5 right now. Most people think they're going to be around 4.
Wow. And that would be more of a 6-ish cut, right?
6-ish, yeah.
Which is what everybody's joking about. Like, everybody's saying it's going to be 6 cuts. Like, in fact, like, I feel I've seen more realtors, more financial advisors, more people in the industry that, they're commenting 6, because, and I don't even know what kind of triggered that initially, But that's the hard part is well, the Feds are saying 3.
Yeah, they're saying. But what I think a lot of people forget is, why do you cut rates? What's going on in the economy that you need to cut rates?
It's going poorly.
What?
It's not going good.
Right. Yeah.
Recession. Recession, bad. Bad numbers. Unemployment is up. Things that are negative typically drives
rates down.
Rate cuts.
Yeah, because you want to stimulate. You want to, make money easier to get, make money less expensive to get.
Yep.
So everyone's being jubilant that, wow, we need a 1.5 cut because the economy is going to be shit next year.
Exactly. Wait, no. We don't want it to be no, we're ignoring that. It's not going to be shit. It's going to be great because we're going to cut the rates.
But if it's great, why do you want to cut the rates? Why do you have to cut the rates?
You really don't. You don't need to.
But you're got to.
But this is exactly what we've been talking about, is if we do things too fast, if we spur the economy too fast, the Feds aren't going to respond with what we need. Because let's take it, all this movement of dropping rates without seeing the rates cut, right? And yes, this is partly of our yield curves getting a little bit closer, a spread between, the 10-year and the MBS being a little bit more into historic norms where it's been kind of setting much, much farther apart. And the challenge is, well, if that's all it took to spur the economy back up, the Feds are going to say, wait, if we cut rates, what will that do?
Yes.
That'll put in overdrive, and we don't want a repeat of 2020.
Yep. And we'll end up with labor shortages again, which will force payrolls up, which will force inflation up. And we've just killed everything we've done for the past 2 years.
And then they'll do what they did in the 80s, and they'll double down
and
say, you know what? We tried a soft landing. Soft landing didn't work. Now we're gonna have to crash this bad boy.
We're gonna have to crash this bad boy. Yeah.
That's what we don't want. And that's the hard part, is I think across the board, a lot of people see surface level and they don't realize the bigger implications that can happen if the economy gets moving too quickly. Now, I think we're in a good position, right? Rates drop, even with December being strong, because we're going into the holiday season, which means it's going to slow down that buying season naturally is going to be slower. I've seen, even with rates dropping, we're picking up a little bit. We've seen applications tick up. We've seen refinances, but we're not in a crazy high, stupid, aggressive market, right?
Correct.
And that's okay, as long as we stay here. And affordability is still an issue at 6.8, whatever, the national average that they were saying, right? It's still hard, to look at homes because, homes are, still, they're $100,000 more, 30% more than what they were in 2019 or greater, in some pockets, right? I don't know what, in some areas is what, 50% more, possibly 100% more. I don't know. So affordability is still an issue. So I think we've got to see the rates and settle down. I'd really like to see us kind of settle in and coast through the rest of the year. I know anybody watching this broadcast right now is like, no, I want low rates so I can take advantage of the best rates possible. And it's it'll be okay. We got lower, but it's, you don't want to see us put ourselves into a situation where we do exactly what you said. We have a labor shortage, which causes payrolls to go up, which causes inflation to increase, which causes the Feds to go, wait, we've got to halt this. How do they halt it? They make borrowing more expensive, which means everything gets more expensive. And then because we've gone through this just so recently, they double down and say, no, we got to really feel this pain for not just a few months. We got to feel the pain for 6 months or a year so that we can get ourselves out of it.
Yep.
That's not what we want.
Yep, exactly. What I found a couple things that were interesting yesterday is he did not once bring up the amount of deficit spending that we're doing. Not once. There wasn't one comment on deficit spending.
Well, if you don't say it, it doesn't exist.
Yeah, $1.7 trillion is just, nothing.
It's proof. Well, we were able to make it out of thin air.
That's true. That's true. But I found that extremely interesting. It's like because he's kind of been on Yellen a little bit over the past year. Like, come on, guys, get your financial house in a little bit of order.
Yeah.
Because I can't control everything with rates if you guys are going to keep just spending money that we don't have.
Yep.
It takes away some of the power of what they were trying to do.
Yep.
And that was the first time I think in probably the last 3 or 4 meetings where he hasn't, put a shot across the bow of Yellen in the Treasury Department.
Well,
So.
I think Yellen laid the smack down in a private meeting or something, maybe. Said who's really boss. No,
yes. Yeah, that'd be an interesting one, wouldn't it? So it's nice. It's good to see. I'm glad to see that they're holding. We've peaked. We've mentioned it several times. We felt that we had peaked.
Mm-hmm.
And he said it yesterday. Is hey, we're still waiting for the rest of our rate increases to get through the system. So now let's just pause. Let's let them get through the system.
Yep.
And in the past couple of weeks, we've seen this. Hasbro, toy company, at Christmas time.
At Christmas time.
Yeah. 1,000 layoffs.
Yeah.
Etsy, one of the biggest online stores in the world. Christmas time, layoffs.
Christmas time.
Ford, who just spent a ton of money retooling their Lightning electric truck facility, just said they're cutting their production in half. So it's not all roses and rainbows out there right now. Yeah. It's still working through the system.
Exactly.
And I think we're gonna see things tightening. I saw an interesting chart first thing this morning, and I didn't realize this, that after the first rate cut by the Fed, if you look historically, we have within 3 to 6 months, you have a huge increase in unemployment, which is like, oh, that's not fun. And that was just one thing. It's like, that's something you don't want to see either, because we're sitting. I mean, it's nice when you see, roughly we're at 3.7% unemployment, and it's been a very steady number, and it's nice to see, the people have jobs, people have the ability to go out and replace jobs, and that it's not the fear of losing the job so much now. I think it's more of just, hey, can I afford to go to the grocery store this week? Oh my gosh, did you see the comparison of what it costs for Macaulay Culkin from Home Alone when the movie first came out? He went to the store and got these 4 or 5 items, and it was under $20. They went to the store; it's now $76 for the exact same items. That's expensive. That one was just kind of wow. That one kind of just blew me away. So, well, that's where all of our numbers are. But this was something that you and I wanted to talk about, which is kind of off the sidelines in numbers. And a lot of people have been complaining for a while about the hedge funds purchasing the majority of homes. The numbers I've seen aren't quite as high as this. This report saying that 44% of the single family homes last year were purchased by private equity firms. That's huge.
44%? Like,
I thought it was around 2021.
That seems so. That's like I just feel like that's a massive number. Like, I knew hedge funds and equity firms were a big proponent of the buyers, but my gosh, like what? I mean, obviously, that's telling us that there's a lot of money to be made in home ownership.
Yes. Yep. But you got to remember, a lot of these are buying them to rent them.
Mm-hmm.
And I can understand this, couple of years ago, seemed like every house you were competing against some type of investment company. When Open Door was throwing money around like it was water at the time. And so you're looking at this like, man, 44 seems really high. I've got to look in this number a little bit more. But it was interesting because I saw this, and on the same day, I saw this, that in the U.S. Senate, a bill has been introduced to end Hedge Fund Control of American Homes Act 2023. So what they're doing is they're going to try and force these hedge funds to exit the single family housing market.
And I'm not, and I think you're a little bit more versed on this. Hasn't the government in a lot of ways aided these hedge funds in being able to buy?
Yeah.
Like now they're like, wait, oh shit, we messed up.
Oh, here, help us. And then it's like, oh, well, we didn't mean help us that much. It's like the government does things and they never think of the unintended consequences of the actions. And that's one of the things. And a big part of this, quite honestly, comes down to when the Fed was buying mortgage-backed securities and forcing mortgage rates down to the 2%, 3%, is it provided all this liquidity, and this liquidity went into the hedge funds. It was basically the hedge funds to help stimulate the economy. So what does the hedge funds do? Well, my gosh, if I can borrow at 2%, and I can go buy all these assets, and now they're watching, all these assets go up 15% a year, 20% a year. Where are you going to put your money? Where the asset class is going up quickest. Yep. That's the job of a hedge fund. Provide the best return for your clients. Well, we created it. We created the market.
Yep.
So, I mean, BlackRock right now, they're supposedly sitting on another fund over in Europe of 770 million euros to start buying houses in Germany and a lot of areas of the EU, because their market is starting to actually drop down. So they're looking at buying opportunities, and it's just, you look at this, and the other interesting thing is BlackRock right now, a lot of people don't realize this, is they're huge, they're great, but do you know, for their real estate investment trust, their largest one, you can't withdraw your money.
Wait a minute. So I gotta put my money in, and I gotta leave it, and I gotta. So wait. If I can't withdraw my money, does that mean, like, is it set up into a structure where it's like I'm investing, but I may never be able to actually get my returns?
Basically, yeah. They just have it set. They have it set up, and this goes back to our whole discussion with commercial mortgages. Is that the real estate investment trust's main focus is all commercial properties. Well, here's the problem. Just like we had a couple banks fail, if you all of a sudden get a small run on that real estate investment trust for BlackRock, and you get all these people starting to line up wanting to take out their funds, it's not liquid. It's not liquid. It's all tied up into properties. So how do you get your liquidity? You have to sell the properties. Well, what's the problem with commercial backed properties right now? They're worth about half of what they were 3 years ago, because nobody wants to buy them because the interest rates are too high for commercials. So you just look at that, and I believe in capitalism and the free markets, but I have to look into this deeper, because I don't want to say, I agree with this law, but at the same time, you guys made your bed, and now you need to fix it. But by fixing it, what are the other problems you're going to cause?
Yeah.
Because if you take all these houses, I mean, even if it's over 10 years, do you all of a sudden create a glut in the market, and you've just destroyed home appreciation?
Possibly, right?
It's very possible.
I mean, it's 40, 1 and 2 houses basically were bought by what's that going to do? Do we really have the shortage of homes in that situation? I'm assuming we still do, right?
Yeah. Yeah. There's so many cans of worms that you can open up to this, and then, okay, what about, at what side, what's a hedge fund? Do you count a real estate investment trust as a hedge fund? Because there's huge real estate investment trusts that own thousands of properties too. It was an interesting one to see both of those. 44% just still blows my mind.
Yeah, that's massive. That's a huge number.
It's absolutely huge number. So, all right. So we got into those. Let's look at our numbers here in Orlando.
Locally, I think it was busy. No, I doubt. No, it wasn't busy. It wasn't. I didn't feel like last week was busy. I felt like it was very slow.
I was. Tell you what. After our show, I also went and was had the flu for this is actually the first day I'm back, and it's all your fault. You had it like 2 weeks before.
It probably was my fault. I'm gonna blame my kids for that when they brought it home from the school. I blame the public school system for the flu. No, I'm just kidding. Hot take. Ignore it.
But I mean, it was slow, very slow. We only had 272 homes sold last week.
This is a non-holiday week.
Yeah. I mean, but again, look where the rates were. We're sitting close to 8%. For some people, they probably were over 8%.
Yeah. I think we had a little bit because you're talking. These were borrowers that locked at the start of November. Or late October when rates were much higher. Then we saw all the improvement in November. I'm not going to lie. We had a number of borrowers that were like, they canceled to be like, hey, let's see if we can find another property because rates went down. Maybe we can look a little bit higher. We also had a lot of borrowers that, potentially negotiated extensions on closing so that they can float down to lower rates, right? Okay. Because we had the ability to float down. So, this week, and I will say even internally, like last week was pretty slow. We saw about a 3x in files closing this week compared to last week.
Gotcha.
So we're picking up massively on our side. A lot of that, I think, has to do with what the market did.
Yep, makes sense. This is the one I think just really hurts is we get into the condos, and you only had 93 condos sold last week. I mean, the condo market in Orlando has just dwindled to nothing. And we actually almost had more new condos come on the market than they had sold last week. I mean, we're up to almost 2,500 units for sale right now. And then when we get into our numbers on the original list, the sales price, the average discount is $25,000 off the original. That's a big discount. That is a very big discount. And then, we're sitting here at 95% on the original to the sales price and 97. So you see, you got plenty of room, plenty of movement in there. The average days on market is going up again. We're up to 50. We're almost up to 2 months now.
Wow.
So that number again is increasing. Why? Because rates were popping up. Hopefully we'll start to see that drop down. And then our graph for weekly sales, it just slow, absolutely slow. We've got numerous over the past month, numerous points below what the period average is. And then our inventory just continues to grow as well. We're up to 4,600, so we've got 22% more homes on the market than we did last year. Which I think
that goes down in January.
Yeah. So we got to start all over. But that's, it's just, I think we're going to continue to see that number to grow. I think people may feel a little more comfortable trying to sell their house, if they see the rates stay in that 6.5% to 7% range.
Yeah.
Where I think a lot of people it was frustrating. We saw the numbers of how many people were withdrawing their properties off the market because they'd sat for 2 months.
Yeah.
With no action. I've got a friend of mine right now. He's got a townhome priced correctly, compared to all the other ones, and he's had it on the market for 3 weeks, and I think he's had 2 showings.
Wow.
That is it. That's it. And then condo market, we're seeing the same. I mean, look at this. Condos, which are usually priced less, their average discount off the original is $26,000.
Ooh.
Pete, and look at this original list of sales price, 92.
Well, the condo market, we've been saying this for a while. It is gonna feel, and I don't even know if rates dropping is gonna help the condo market right now.
I don't think it is.
I think with what's going on with the insurance aspect and the regulation tightening, and I was talking to a great friend up in Maryland, and and he does a lot of condos. There's a lot of condos actually in the Maryland, DC area, and so forth. And he was just like, he's just like, dude, Florida is just a whole different beast. Like, you guys deal with stuff on condos that nobody else. And it's unfortunate because we've got a lot of different pieces and the maintenance of the codes. And then, what unfortunately happened, down in South Florida, like that's going to have ramifications. And there's guidelines. If you look at Fannie Mae and Freddie Mac, there are literally a cutout for Florida of increased restrictions on condo requirements. So it's like condo guidelines for Fannie Mae, Freddie Mac are this across the entire nation. And then it's like subsection for Florida, these additional items apply. Right? So
Florida man.
It is what it is.
Yep. And then, I mean, you just look at the inventory. I mean, we are up 62% over January of last year. That's huge.
Yeah.
That is huge. And our average days on market have jumped to 51. And I just see this continuing to go up. And I just think you're going to start seeing some huge price drops.
Am I going to be able to buy a condo in Sable for like 20 grand again?
Maybe not 20. Maybe not 20.
Hindsight, I should have bought properties up in 2011, 12 in Sable. Because I think they were going for like 15, 20 grand back then.
They were. It was,
and they're going for what, 180, 200 now?
Yep. I think you're going to see a lot of them pull back to like, 140, because I'm sorry, when you all of a sudden have a $700 a month, $800 a month HOA fee.
Yeah. The affordability ain't there anymore.
No, it's not.
Savings? Nope.
I mean, the one complex, was it Lakeside, or I can't remember exactly, over here in Altamont, that they're jumping to 900 January 1st. In the past 2 weeks, there's been close to, I think, 18 or 19 properties listed.
And was Lakeside was that a hotel conversion? Or am I mixing? No, I'm mixing them up.
I know which one you're thinking of. No, that's not the one.
That's not the one. But this is like a $900 amount. What's the price point on these? Do you know off the top of your head?
2-bedroom, 1 bath right now is $180.
180. So you're like $900 HO or condo dues on that property. Like that. I hate to say this, like that community may be like, and you hate to say this, but like it's done. Who can afford to live there still? Who can justify? And I bet you that's a heavy investor-owned complex.
That's almost all the ones that got thrown on the market. All investors.
Yeah,
all investors. I mean, what do you charge for rent? What do you charge for rent?
Yeah,
the rent in there was going about $1,400 for a 2-1, $1,500. And now all of a sudden you got to pay $900 of it to your HOA.
Yep.
You're not going to jack the rent up to $2,500 because everyone's going to look at you like you're freaking smoking crack.
Yeah.
I'll go rent a house for that.
all those investors were like, please let rents keep climbing. No, thank goodness they didn't. I'm happy they didn't. Sorry. But yeah, that's a tough scenario. Very, very tough scenario. And the problem is all those investors are going to get out of there. You're not going to get investors back into there because it's not. So you're going to need people to buy it as a primary. But I'm like, when I talk to clients all the time that are looking at condos, and I tell them, hey, this is how much additional home you could be looking at if there was no HOA. Weigh your options. I'm not saying condos are bad, but make sure you look at it, because the reality is a lot of people go into condos because they want to remove the maintenance aspect of it.
Yep. Yes.
But if the maintenance aspect is so expensive that I can sit there and say, hey, you can buy a single family over here for $50,000 more and pay for lawn care and pay for pool service, and it still be less a month than what that condo would be with a $900 condo due.
Yeah.
Most people are going to say, okay, that sounds good.
That makes sense.
Tell them like, hey, by the way, if you feel like things are tightening and you want to get rid of lawn care and just do it yourself, you have that option. Don't have that option in a condo.
And then the other thing is resale. You know, their resale's just been destroyed. Totally destroyed. And they're going to end up, you know, you've got some people who've bought within the past year or two, you know, and they're say goodbye to your equity.
Yeah.
You know, the equity that you had, it's gone. And you may very well end up underwater.
That's scary to be like, hey, you bought with all this appreciation when the market's appreciating so much. And there's going to be, and I think in Central Florida, I'm really like, I'm going to say this, like maybe a little bit of hot take here, and we're getting a little bit long, so I probably should do a hot take right here. Is we've got a heavy condo community that's been impacted, and the Airbnb community has been impacted majorly. Like, I think we've held steady, but if we don't see great appreciation continuing, it's going to be because of those two areas softening our market significantly.
Yes. Yep. I agree with you completely. Completely. Well, let's wrap it up. Thank you, everyone, for joining us, and we will see you again next Thursday. Please remember to like and subscribe, and stay up to date with everything real estate at the Orlando Real Estate Buzz. Take care.
Awesome. Have a great one, guys.